Hi, it's Kathy. Today I want to talk about banks and credit unions and how they differ in their ownership structure, customer service, and profit distribution. Here are some of the main differences, and really it's about ownership and customer focus. Banks are typically for-profit institutions owned by shareholders. They aim to generate profits for their shareholders and often have a larger scale of operation. Credit unions, on the other hand, are not-for-profit organizations and they're owned by their members. Members of a credit union share a common bond, such as working for the same company or living in the same community. As owners, members have a say in the credit union's decisions and elect their board of directors. Banks generally cater to a wide range of customers, including individuals, businesses, and corporations. They have a broader customer base and may offer a variety of services to meet different needs. Credit unions tend to have a more community-oriented focus. They prioritize serving their members and often provide personalized services. Credit unions may have membership restrictions, including individuals to meet specific criteria to join. Banks aim to maximize profits for their shareholders. They generate revenue through various fees, interest charges, and lending activities. Profits are typically distributed among shareholders in the form of dividends. Credit unions as not-for-profit institutions focus on providing benefits to their members. They aim to offer competitive rates and lower fees. Any surplus funds generated are reinvested back into the credit union to benefit the members in the form of lower loan rates, higher savings rates, or improved services. Credit unions are regulated by agencies like the National Credit Union Administration, NCUA, in the United States. They have regulatory requirements, but they also have more flexibility in certain areas due to their not-for-profit status. It's important to note that both banks and credit unions provide essential financial services. The choice between them often depends on individual needs, preferences, and the specific offerings available in your particular area. Recently, I needed to cash some Series EE bonds, and I don't have a local bank, so I couldn't go into a branch to cash them. And then I remembered that I had an account at a local credit union. And that made me wonder, what are the differences between the two? Let's talk about banks first. They'll probably offer an app that allows you to do online banking with general ease. Since banks run for profit to make their money, their investors will offer a wider range of services to entice you to put their money into their company. They also have apps that allow you to pay bills, transfer funds, and make deposits from your phone. Sometimes you can even apply easily for a loan. One benefit is that you don't need to go into your bank to use many of the banking services. However, when you do need to go into a bank for some reason, you'll probably be able to find branches. Those are brick and mortar buildings. They have ATMs throughout the region that you live in, or even throughout the country. You'll be able to use your bank's ATM machines, and that will probably mean that you don't owe money and fees for using them. Some banks have agreements with other banks that they won't charge you a fee at all, and then others, like mine, will reimburse you for any ATM fees that you incur while using other companies' machines. There are many rules that banks are required to follow that surround their customer service, meaning that they have less flexibility in how they can provide services to you. Sadly, banks have reputations for poor customer service. Bankrate.com has a list of the top banks for customer service, and they've ranked them. They found that PNC Bank, Citibank, Ally Bank, Bank of America, Wells Fargo, and JP Morgan rated highly. Check this out if you're looking for a new bank. But they found that JPM seemed to have larger branch of networks, impressive mobile app, 24/7 phone service, and it earned a lot of customer service praise. Banks also have many options for how you can put your money to work for you. They'll help you plan your retirement and help make investment choices. Banks use the money that you've deposited to lend out to those who need loans. This might include mortgages and other short-term loans. This will apply to both individuals, companies, and even other countries. They can process money nearly instantaneously while they offer credit and debit cards, as well as the payment from complex regional, national, and international accounts. Not surprisingly, they need to make a profit, and they do this from its customers and those who invest in them. They make their money in what's called the spread. It's the difference between the interest rate they pay you for leaving your money in their bank and the amount that they collect from lending your money out. The money you earn interest on, your checking, your savings, and CDs, earn money because the bank is lending that money out for mortgages, auto loans, and other personal loans. They may charge, for example, 5% interest to the borrower and pay you 2%, the lender. The difference is what they keep for their profit. Banks will earn on average 1 to 2% on their assets. That's in the loans that they make and the securities that they already own. Opening a bank account is pretty straightforward. You'll need to prove who you are with a driver's license or a government ID if you don't drive. You'll need your home address, social security number, birth date, and phone number. You'll need your social security number because will report any interest that you earn to the IRS. And then you'll receive a 1099 INT, or one will be made available for you online to include in the income you've earned for the year. To open an account, they'll probably expect you to provide an initial deposit, but sometimes they don't. So find out what your institution's going to require. NerdWallet.com has bank ratings, fees, interest rates, and suggestions on even closing an old account. From here, you'll be able to pay your bills, write checks, and use your debit card. Keep an eye out for banks that have no monthly fees, low or no overdraft fees, and that's what you pay in fees if you write a check for more than you have in your account, and free access to ATMs. Anyone under 18 will need a co-owner on the account to be able to sign legal documents. Credit unions, on the other hand, are nonprofits owned by all the members of the credit union. There's a Credit Union National Association, and they state that over 130 million of us belong to one. One of the benefits is that they want to keep costs low and interest rates high because they're not required to make a profit for their members. Another big difference is they have to limit their customer base, and they do this by offering their services to specific groups. This might include the company where you work, school, a place of worship, geographic region, or even belonging to a specific organization. Although you'll need to look for how you qualify, it's quite probable that you'll find one that you can easily join. Credit unions have interest rates that are higher on savings, CDs, and money market accounts than banks do, and they charge less in interest rates for mortgages and car loans. I've kept my credit union account for that very reason, in case I need a car loan. The fees also tend to be lower than banks for bounced checks and service charges. There can also be no to low required balances for your accounts, which is nice if you need it, or if you just want to keep your membership open in case. As I said, I needed to cash out some savings bonds, and my local credit union would do that while the bank I belonged to did not. However, it's not uncommon for credit unions to offer fewer ways to save than banks due to their size. So if you're hoping to get investing assistance, your bank might be a better opportunity. Mobile banking options may be limited with a credit union, so check out what offerings they have for online choices and that they'll be able to meet your needs. However, you may have financial education or outreach programs that you can attend, offer in-school credit union branches, and special services for small business needs. Some credit unions are low-income designated, and they offer services to people of all income levels, including those who are underserved or unserved by traditional banking institutions. There are also low-income credit unions that have a majority of its members at 50.1% who earn less than 80% of the median family income or the earnings for the area they live in or the national metro area, whichever's greater. To see if you qualify, you can stop by mycreditunion.gov and see what their requirements are. Both of the programs offer access to accounts with low minimum balance requirements, small dollar loans, credit building loans, loans for limited, negative, or no credit history, and special services like money orders, frequent withdrawals, financial education, or other kinds of financial counseling. Both banks and credit unions have Federal Deposit Insurance Corporation, FDIC, coverage, which is insurance up to $250,000 of your deposited money. The federal government has instituted this insurance as an independent agency created by Congress to maintain the stability and the public's confidence in our nation's financial systems. Banks and credit unions are terrific for different reasons. One is not better than the other. In fact, you might consider opening an account in both to take advantage of all of their services. This has been Kathy Pfeffer-Hahn. Thanks for listening. Be sure to subscribe and like. Please stop and leave a comment about which you have, a bank, a credit union, or both, and why. Until next week.